What's up, YouTube? It's Todd Horst here with Tasty Tracker, and today I wanted to talk about running the wheel and why it makes no sense. So first of all, if you haven't seen episode 16, Options 101, that's a quick primer over how to set up options and what they are, and you're going to want to watch that first before you jump into this video.
Episode 31 is covered calls and why I hate them. This is kind of a continuation of that discussion, although I cover different content. That was more about setting them up, and this is more about the theory around them. So, third bullet point here is I hate buzzwords. I'm a manager by profession, and I hate management speak. I hate when people try to speak in a manner that will where they try to elevate themselves and they try to belittle others in that process, etc. And so part of that I see a lot with the different forums and stuff. They're talking about Theta Gang and Wheel, and these are just made up ideas that basically drive me nuts. Theta Gang is more than the Wheel, so the people that are claiming that that's all it is don't really know what they're talking about, in my opinion. Theta Gang is all about collecting theta, and and you get that by selling calls and puts or different spreads, etc. So that's sort of the context around this episode. Me trying to help people on forums, and then getting aggravated with people that have these weird ideals. I've talked about this before, where they have some rigid set of rules in their head of what they think something should be, and life isn't as rigid as that is. So let's jump right in. People starting out like covered calls. Typically, they're starting from stocks, so they own some stock, and so let's say they own 100 shares. Well, covered calls is the natural step into options, so they can sell a call and collect some premium to reduce their cost basis on shares that they already own. And from that perspective, it's relatively safe. But if all you did was play covered calls, first of all, you have to know that it's not error proof. You can still lose a lot of money because you have all of this capital tied up into the underlying stock. It's also very capital intensive. So even if you don't necessarily lose money, you're not having the best ROI potentially as you could. Of course, I will say that if you're flat or making some money off of cover calls, then you're doing better than a lot of people anyway. So I'm not necessarily saying this is the worst idea. I'm just saying that there are better opportunities out there ROI wise than just doing cover calls. If you have a small account, it's really important to not focus on cover calls because um, you're only going to be able to afford a lower priced stock, and those lower priced stocks are lower priced for a reason. They're not as reputable companies, more likely to go to zero. So owning hundreds of shares of them isn't the best idea, and sometimes they can be very volatile, which also, depending on when you time it, if you get lucky, then that could be a good thing, but a lot of times it turns out bad for individuals who have a lot of money in these penny stocks. So what I'm really thinking about and talking about here is people that talk about the wheel as if it's this one size fits all. It's the ultimate strategy, it never fails, and it can be the only strategy that you use. I'm of the opinion that no one strategy is the best strategy. You kind of have to read the market and choose which strategies you use at specific points. You're going to use different ones throughout time, and then on top of where the market's at, you as a trader, you're going to evolve, and so you're going to lean towards these strategies during this period of your life, and different strategies, different period of your life as you evolve as a trader. So aiming for the wheel, to me, makes very little sense. Covered calls really only make sense here if as a solution to getting assigned, and especially if you don't want to get rid of the shares, so you want to keep the shares in your head. You're thinking, oh, this is a great company and they have good potential. Then I'm going to deal with shares that I got assigned here, and in the meantime, I'm going to sell some covered calls. Now I say here that you don't want to get rid of the shares, but in reality, it's that you're a little bit indifferent. You don't mind holding the shares, but you also wouldn't mind if they got called back away. Okay, so a lot of times people say that they're going to get into running the wheel, and that they're willing to hold the stock as long as it would take in order to be profitable. And that's ends up, in my experience, what you spend the large majority of your time doing when you're holding the wheel, when you're running the wheel specifically, again, the wheel as a whole. You spend a lot of time waiting just to break even. You'll sell the cover call, then the stock dips, and you sort of get into this pickle where you have a more complicated position because you have stock and options. And if you close the option, you are going to actually have to pay more than what you sold it for, or maybe if the stock goes down, then you're going to be paying less to buy it back. But then the value you lost in the shares don't offset that. So, and then on the initial setup, maybe you collect a good premium, but as the months go by, you're going to be getting less and less premium, whether that's because of IV or other factors. So it's not so easy to just say, hey, this is what the wheel is producing this month, and so I can project that out into the future indefinitely. But back to my last bullet point here. A lot of people, when they get into the wheel, they say, oh, I don't mind holding these shares for forever. I don't mind holding them for months and months, years and years if I have to. But reality comes where they've held shares for 2 or 3 months, and by that point, most people are going insane trying to get rid of the stock. They're even willing to get out of the position for a loss because most people are like me, and you kind of hate seeing that same symbol in your portfolio, especially if it's been red since day one. So that they say that they would hold on to it, but reality is that they won't. So that's another thing to consider if you're going into this thinking that you want to do the wheel and you're okay holding the stock as long as it takes to be profitable. Okay, so let's talk about the objectives here when you're running the wheel. A lot of people start off, like I said before, with the stock and then they sell cover call. That's the wrong direction. You actually need to start off with the cash secured put, and that's selling a naked put, and your goal there is to never take ownership of the stock. So you want the stock to go up, you want to close at 50%, and you want to do that over and over and over again. Or maybe even the stock can stay flat if you sold your strike below the at the money strike, which is what you should be doing as well. That's the ideal. It's the purest form of option selling. It's core to all strategies. If you're doing any vertical, there's a sold leg. If you're doing an iron condor, there's 2 sold legs. So removing the complexity of other option strategies as well as covered calls where there's stock and options, the cash secure put is the ultimate idealized option position. It's not complex. It's very easy to understand. And so with that, your backup plan is, okay, well, if things don't go my way, the stock ends up going down against me and plummeting through my strike that I sold, I'll just take the ownership at that strike of the stock that I'm okay owning, and that's my backup plan, and that makes sense. And the last bullet point here is overall that's going to be better ROI because you only have the capital outlay to purchase the shares. If you're in an IRA account, if you're in a margin account, it's actually going to be less than that, which is both good and bad, and I'll get to that in a minute. But either way, the cover calls going to be a better, cash secure puts are going to be a better ROI, but they're not quite as good as what a short spread would be. So I'm still going to recommend the spread. I'll get into that in a second as well. With cover calls, what's your goal there? Well, you want to sell a call. Ideally, if you actually like the stock, you don't want the stock to get called away. You want the stock to stay flat while your call is open and then close it at 50%, similar to the cash secured puts. And then you do that over and over and over again, collecting premium all the while reducing your cost basis. And then finally, you want to close out of your short call, and then you want the stock to go to the moon, right? So that you collected all that premium and were able to close those successfully, and then you want to have the stock go up. Covered calls are more of a way to hedge your existing position, to lessen your current losses, reduce your cost basis, buy time and sideway action. Those are kind of the areas in which you'd want to open a covered call. But the best case is that it stays flat. If it breaks your sole call, you weren't so upset by getting the stock called away. That's okay. You were okay with either situation. And if you positioned the call that you sold, the strike, correctly, then you made money both on selling that call and your stock increasing in value. So what I'm trying to say here is that the wheel itself should not be your goal. Your goal should be cash secured puts. And then only after you get assigned is when you turn that into the wheel. It's a way of turning lemons into lemonade. But instead of a covered call, I would actually recommend just simply holding on to the stock and waiting until you can exit out at break even, call it a wash. Because that cash secured put lowered the cost per share, you can actually get out lower than what the strike was. So you sold the $25 strike and you collected $1. Now you can wait till the stock gets up to 24, and then sell your shares. If you decide to do a covered call, you're going to reduce your basis further, which is nice. But now, what will inevitably happen is the stock will then go up to 24, 25, and you sold your covered call at 25 because it's still above your cost basis. And now it's like, well, should I close out this whole position? Because of the extrinsic value, things might not line up correctly for you to get out. And it's overall just a more complicated structure than if you just had the stock at that point. So I already mentioned that you should start off with the cash secured put, not the covered call, unless you really are, you're really 100% keeping that stock forever, and you're just make a little bit of extra money, and it's okay getting caught away. So an example there is the ETFs that I'm invested in that are permanent ETFs. I don't ever, and I mean ever, plan on selling the shares. So my idea, it's not like this is unique to me, but my idea is to use options as an income strategy and then take the income from that and roll that over into buying ETFs that I hold indefinitely. Some of those are growth, some of those are dividend ETFs, etc. But I did an episode about that a couple episodes ago. In that case, I'm able to sell covered calls higher, way further out of the money, and just collect a couple bucks. Certainly nothing to write home about. You're only going to get 50 cents max, but your shares are never going to get that high anyway. So it really is just a way to just collect a couple bucks here or there. And if they did for some reason get caught away, well, it's so far out of the money that not only did I collect that premium, but that means my shares went up to that price. So sure, by all means, I'll take the sale of all of that, and then I'll hold it for a minute until stocks go down, or maybe I'll just get right back in. But you have that opportunity to make that decision then. Okay, so next I want to talk about cash secured puts. And I already said of the two, the covered call or the cash secured put, I much prefer the cash secured put. But on top of that, above and beyond that, I prefer spreads. And I already mentioned this. They are way more efficient cash-wise. You don't have to have as much collateral taken up, and that is the point of the spread, to cap your gain and to cap your loss. If you do prefer to do the cash secured put, ready naked puts, that's fine. I definitely have some of those, but you need to make sure you have enough in your account to buy the stock. Otherwise, you will get margin called. I was on Reddit and somebody had whatever 10, 15 forward naked puts, and I'm guessing that their account is not big enough to handle if they were to get assigned on all of those. I could be wrong. They didn't divulge how much they have in their account, but the reality is a lot of the new traders think that they can write as many calls as they want or puts as they want, and all they see is that they're getting more premium than if they did spreads. But spreads are there for a reason, to cap your gain and loss. But I view that more as more efficient ROI because you have to outlay less collateral. So I wanted to go ahead and show the difference of the collateral required between a margin and an IRA, because I don't know that many people have IRAs with options in it, and so they might not be aware of this. But I actually prefer to do cash secure puts in my IRA because with an IRA, they require you to actually put down the entire amount for the trade. So right here I have 83 strike in AMD, and the market's closed right now, so this may or may not be accurate. But the point is, it's maybe $200, $250 around that area that I could collect for an at the money kind of strike. I'm selling the put, cash secure put. And because I'm at the 83 strike, the total amount that would be required is $8,300. Then you minus the credit collected, 213, and that gives me the potential gain as 213 and the potential loss, we'll call it, as 8087. Now this isn't actually going to be lost. That's just the collateral that's required. If it was below the 83 strike, I would get assigned and I would have to pay 8,087 to take ownership of those shares. And then you can see, obviously, it's a dollar more for commissions. So keep this in mind. The buying power reduced by $8,088. Now let's go over here. This is my IRA. Let's go over here to a personal margin. Okay, and we'll go to trade. Same setup here. 83 strike on AMD, 213 as the credit. Now, now you can notice the buying power is reduced only by $1,600. So, you know, what happened to that other $6,000? Well, Tastyworks is fairly confident that AMD will be above $83. It's sitting at 83.10. There's a 50% chance. In other words, if we go back here and look at the percentage in the money, there's a 50% chance, 50-50, that it will be above it. So what happens then if AMD, well, let me state this again. If this turned out to be out of the money and worthless at expiration, that would be fine. They would never require any more margin. But if the stock starts going down, and your stock or your strike now gets pushed down and down and down and down, and so now there's like an 80 or 90% chance that it's going to be in the money, they're going to require more and more margin. So they might up that as the stock moves. They might require now $2,000 of margin, and then the week after that it might be $2,500 worth of margin. And so that's a floating number that if your account does not have the funds to support that, now you're going to get margin called. And imagine here if we had 10 of these, because I have a $20,000 account in this margin account. So now I have 10 of these, but now they just increase it by $1,000. They went from $1,600 requiring to $2,500. But I sold 10 of those, which means I need 10 times 1,000. I need $10,000 extra dollars just on this one position if I had 10 of these. So you can see here where people are going to over leverage themselves and get into a situation where they cannot handle the margin. What happens then? Well, they either can deposit money into their account to bring their account back up to zero, or they have to close out of the positions. And obviously, closing out of these positions when it's going against them is the worst time to close. We all know options go in your favor for a period of time, and then there's a wild swing, and they're out of favor, and you're down on the position, and sometimes for an extended period of time before they come back into your favor. But a lot of times they do. You just need the time and the patience in order for that to happen. Well, if you get a margin call and you can't afford it, then you're not giving the proper time to the position. You have to close it and take the loss, and now you are out of everything. And a week later, AMD could go shoot right back up, inevitably, and you're sitting out, and you lost all that money, and it wasn't necessary. Had you done spreads, or had you done this in an IRA, which there are reasons to do either, but had you done a spread, your loss would have been capped, and so you might have been sitting at 100% loss, but you could have at least held on to those because there would have been no additional margin required. So, obviously if it's 100% loss, I'm just going to hold on to it because what's the worst that could happen? You can't go more than 100%. You should still close out early, right before expiration, the week of, but I would give it that entire period of time until the day of expiration. Why not? Because you're already down 100%, but still close early. But so one reason to do spreads or to keep it in a margin is because you have better access to those funds. If you're profitable over and over again, you can withdraw that money. If it's in an IRA, maybe I should do an episode about this later, but an IRA is a retirement account, and so you'll get penalized if you take money out. So that would be a reason why you wouldn't want to do it in an IRA, but you can do spreads in an IRA or a margin account. So in either scenario, I would still recommend the spreads. Okay, so let's get back to the presentation. Hopefully you understand what I'm saying now, that and the difference between a margin and an IRA with the margin call. Okay, so cash secured puts are nice to eat up a lot of capital. I know there are a couple gurus out there that only do cash secured puts so that they stop themselves from being greedy and over leveraging. And if you're, like I'm saying, if you're doing that in an IRA, that's true, you can over leverage. But if you're doing that in a margin account, you can very, very easily over leverage if you're not keeping track of the maximum amount of collateral that would be needed. So when you're selling a put, you know what the maximum collateral needed is because the stock can only go to zero. And anybody that's recommending selling naked calls regularly, do not follow them because there is infinite loss there. You don't know how high a stock could go, so you actually can't even calculate what the max collateral will be. It could be this much going starting off, and then as the stock goes up and up and up, you will need to continue to increase the amount of collateral that you have. So anyway, you should just be aware of cash secured puts. I don't think people stress that enough, especially in a margin account. So yeah, know what you need in collateral and limit the number of cash secured puts that you do, and try to use spreads more. That's my recommendation. So instead of using cash secured puts as a way to eat up large chunks of your account, I think it's better to practice self-control. I mean, that's probably one of my hardest areas as well, and why I do move money around between accounts. First of all, I want to make sure there's enough cash in my account on hand at any point so that I can take advantage of opportunities. So I know this is time sensitive, and this video hopefully will not be, but the past couple weeks have been sort of flat down, and we're about to cross over a threshold where we hopefully will have a little bit of a bull run here. So we'll say about a month ago, I started raising cash, reducing my positions, my market exposure, whichever words you want to use, I started closing out my positions and increasing my cash on hand. And then in the past week and a half, I've been, as it sort of stabilized at the bottom, I've been entering more positions, and now I'm about more of an average of what I have uh, out in the market as collateral. So I'm sitting at a pretty typical level. I still have cash on hand. So that is how my first priority. Second priority is I want to, like I said before, purchase stable but increasing ETFs. I want something that keeps up with inflation. I don't want to lose out to inflation. I also don't want something that's a little bit wild, a little bit volatile. Like the metals can be very, very, very flat, and then they can shoot up or shoot down depending on the news. So I have a little bit in bonds. I don't have much in metals, but I have some broad indexes and then some dividend indexes just to have a little bit of income that way. But that's, as I said before, those are permanent holds. So I put that money into the ETFs and I don't expect to ever take them out. And actually, I have different IRAs that I have ETFs in. So if you weren't aware, you can have multiple IRAs. And as long as you don't contribute more than the annual amount to all of the IRAs combined, then you're good. So the max contribution for normal aged people is like $6,000, something like that. So I can put three into one IRA, 3,000 and 3,000 into another IRA, and that's all fine. You just can't do six in one and six in the other because then you would exceed the maximum. But anyway, I like to keep all my ETFs in another IRA so that I can basically stay focused on options in my other IRA. And that's my last bullet point there. Use separate IRA accounts to help ensure you don't have access to too much. So the other way I do it is in Tastyworks, at least you can hide your shares and only look at your options positions. So that's another way to keep it sort of out of sight, out of mind. I only keep my option position shown most of the time, and then I'll check my stock positions once a month just to see what's up and what's down, and whatever is down, whichever ETFs are down are ones that I dump more money into, which everyone probably has their different policy on that. But my theory there is that those are the ones that have been beaten down, and then they'll have a chance to increase. Obviously, if you were to see one continually going down and down and down, then you wouldn't want to keep dumping money into it. But again, sort of the criteria for even being ones that I invest in are ones that increase over time. Okay, so that's really all I had today. I sort of just wanted to stress that theta gang style trades are more than the wheel. The wheel actually doesn't make sense as an objective. You should consider what's more efficient, and spreads are more efficient. If you want to do some cash secured puts, that's where you should start. And that, as far as the wheel is concerned, that's where you should start off. And those are fine, but then make sure that you're either doing it in an IRA, you're keeping track of the total amount of collateral that could be needed, or you're just skipping all of that and going right to spreads, which makes more sense in my head. So that's the summary of what I'm trying to describe in this episode. So anyway, I have broker links in the description if you're interested in that. Definitely comment and share, like, subscribe if you can do that. That helps me out a lot. I would definitely like to get up to 500 subscribers here soon. That would be amazing. I do have plenty of videos planned. This video took me forever to get out because each time I filmed it, I do these all in one take. I kept running into different issues with what I wanted to say and how I wanted to convey that information. Tasty Tracker is my site if you're interested in that, completely free. You can go there, see my trades and the small account challenge be opened up as they are opened in real time. Or you can pay for the pro tier and get all of my alerts, not just for the small account challenge, but that's optional. You can also track your own option trades and stock trades there, so that's nice too if you're interested in that. As with all my videos, this is just for educational, entertainment kind of thing. And hopefully you took something away from this that will be helpful or made you think. Definitely don't take my word for everything. Do your own research and experimentation, and let me know if you disagree or if you have other sort of ideas or flavors of these ideas. Let me know in the comments and we'll have a discussion. So that's it, and thank you. Have a good day.